Welcome to the deep dive. We take that dense research stack you have and, well, we cut right to the chase, finding the most valuable stuff for you. Today, we've got a pretty critical mission, getting inside the engine room of, really, the modern tech world. We're talking about Taiwan semiconductor manufacturing company, TSMC. We need to figure out its financial health, its competitive shield, and maybe most importantly, is this incredible company actually a good value right now?
Yeah, and that's vital. Our sources, they're really clear on this. TSMC isn't just, some big tech firm. They actually call it a single point of failure for the whole global tech supply chain. It's that serious.
Wow, so basically, if you use a smartphone, care about AI, or just want to understand global tech flows,
You absolutely have to get a handle on TSMC. We need to look at their strengths, sure, but also the huge risks they're navigating.
and we're definitely armed for this today. We've got a detailed Q3 2025 financial report right here. It covers, well, everything from the latest earnings all the way to a deep 10-year valuation analysis done sort of Buffett style.
Exactly. And our goal here is to take the market temperature of TSMC. It's this phenomenal business, totally dominates cutting-edge chips. But is it priced for reality? Or is it priced, for absolute perfection forever? We'll use this rigorous financial analysis to find out.
Okay, let's jump straight into that engine room then. The recent results.
Yeah.
Because these Q2 2025 numbers, they are just staggering. Revenue hit NT $933.8 billion. That's about what, US $30 billion? Up almost 39% year over year.
39%. And the net income surged over 60% compared to last year.
Yeah, these aren't small bumps. This is like monumental growth on what was already a massive company.
And what's really interesting is why. The source of that acceleration points right to their tech advantage. Management specifically said it was continued robust AI and HPC-related demand. HPC, high-performance computing.
Right, the chips powering the cloud, data centers, the whole AI explosion we're seeing.
Exactly, and that demand means they're running their most advanced lines, the 5mm and 3nm nodes, really hard, high utilization.
High utilization is probably an understatement.
Probably, yeah. The sources gave a great breakdown. Those cutting-edge 3nm chips, they alone brought in 24% of TSMC's total wafer revenue in Q2.
Wow, just one node type is almost a quarter of their manufacturing income.
It's incredible. And you see this shift in their overall business mix, too.
You do. I mean, TSMC is a pure play foundry, right? They make chips under contract. That's the core business. But looking at the revenue sources over the last year or two, HPC, that high-performance computing, is now clearly the main driver. It was 51% of revenue in 2024.
It's completely overtaken smartphones, which dropped to, 35%?
Exactly. And this mastery of the AI and data center chip market, that's really what's fueling that incredible 58.6% gross margin they reported.
And that margin, that number, brings us straight to their competitive moat. How can they command that kind of pricing power? The research points to four key things, sort of interlocking pieces. First, it's technological leadership.
They're always first, right?
Consistently first to market with the new nodes. They hit 3nm commercially back in 2022. They just stay one, maybe two steps ahead of everyone else.
Okay, what's number two?
Scale and execution. They have this gigafab model. Think enormous factories, incredibly efficient. Places like Fab 18 in Taiwan. They can churn out over 100,000 wafers a month. The economies of scale there are just immense. Rivals can't really match it.
Unbelievable scale. Okay, third.
Third is something less tangible, but maybe even more important. Customer trust. Since way back in 1987, they've stepped religiously to this no competition, pure play foundry policy.
Meaning they promised not to compete with their own customers.
Exactly. The founder, Dr. Morris Chang, built the whole company on that idea. Our word is our bond. So giants like Apple, NVIDIA, they trust TSMC with their most secret chip designs, knowing TSMC won't suddenly become a rival. That neutrality is gold.
Makes sense. The final piece of the moat.
The big one. Capital requirements. Just building a new leading-edge fab costs. Well, it starts at $10 billion, often more like $20 billion plus. TSMC has the cash to spend big continuity. Their capex was nearly $36 billion back in 2022.
So that kind of spending just keeps series new competitors out. It sounds like an absolutely unbreachable fortress.
It does, doesn't it? But, even the strongest fortresses can have vulnerabilities. If we connect this to the bigger picture, you start to see potential cracks. They're incredibly resilient, sure, but they're not totally immune to market cycles.
Like what?
Well, short-term stuff. The semiconductor market is famously cyclical, right? Demand goes up and down. You get inventory corrections like they saw in early 2023. And just normal seasonality, Q1 is usually slower. Q3 is the peak.
Okay, those are sort of normal business risks. But the sources highlighted bigger structural dangers, didn't
Yes,
they?
absolutely. The biggest long-term risk, the one that keeps policymakers and analysts up at night, is geopolitical risk. It's all about their heavy concentration in Taiwan. Western governments openly call TSMC's dominance a single point of failure for the world's tech supply.
And that's not just talk, right? It actually impacts big investors. I mean, Warren Buffett.
Exactly. Think about Buffett. Buys great companies, holds forever, that's his whole thing. But the source's concern, after buying into TSMC, he sold relatively quickly. And the main reason he cited, geopolitical risk. Even though he called it one of the best managed companies, that tells you something.
Yeah, it really underlines how serious that non-financial risk is perceived to be. Okay, what about other pressures? Competition, costs.
Right. While TSMC has the lead now, Samsung and Intel are throwing billions, literally billions, trying to catch up. They're both targeting 2-nanometer production by 2025, maybe 2026. It's this constant, incredibly expensive race.
And are there cost pressures internally too? I remember reading something about the U.S. fabs.
Yes, that's a key point from the research. TSMC themselves noted their new Arizona fab will have considerably higher operating costs than their fabs back in Taiwan. Maintaining those amazing margins when you're forced to build expensive, maybe less efficient capacity overseas, that's a huge, huge challenge going forward.
Definitely something to watch. Though it is worth mentioning, their management seems very stable. Dr. C.C. Wei, now chairman and CEO, he's seen as continuing that disciplined execution-first culture from the founder.
That continuity helps. And they are unusually transparent, providing those monthly revenue reports. It helps build trust, even when discussing these, frankly, massive risks.
Okay, so we've established it's an amazing business, but with some pretty significant risks. Let's pivot now to the investor perspective. Let's run this fabulous enterprise, as Buffett might say, through his legendary checklist. Does it qualify as a wonderful company at a fair price?
All right, let's do it. Looking at the wonderful company part, using those 10-year metrics from the report, TSMC scores really, really well. Let's start with profitability and efficiency. Gross margin, comfortably above 40%, usually in the 45% to almost 60% range. That's pure pricing power.
Okay, impressive margins. What about how efficiently they use capital, like return on equity, ROE, especially for business that spends so much?
Their 10-year average ROE is around 27%. And now, remember, Buffett often looks for maybe 15% as a threshold. TSMC is almost double that. It shows outstanding use of shareholder money.
Double the threshold. Okay, and the balance sheet. You mentioned it's a fortress, even with that huge CapEx spend.
It absolutely is. Minimal reliance on debt. Their debt-to-equity ratio was super low, like 0.25 in 2024. And interest coverage, how much operating income covers interest payments. It was over 125 times. They generate enormous cash compared to their debt.
Wow. Okay, and my personal favorite, the one that really shows management skill, capital allocation. How good are they at reinvesting the profits they don't pay out?
This number is genuinely remarkable. Their return on retained earnings over the last decade is about 32%.
32%. So for every dollar they kept in the business.
They generated 32 cents of additional annual earnings. That kind of return on reinvestment for a company this huge is almost unheard of. It proves fantastic execution.
Okay, so it definitely passes the wonderful business test with flying colors. Now here's the tricky part for value investors. Where does it fail the strict Buffett criteria?
Right. It generally fails on two key areas that are really fundamental to Buffett's classic approach. First, plain old valuation. TSMC just rarely, if ever, trades at the kind of low price-to-earnings ratio. Historically, it's averaged around 21x or low price-to-book ratio, currently about 7.4x that value investors hunt for. You usually don't get to buy this quality on the cheap unless something really bad seems imminent.
Okay, valuation's the first hurdle. What's the second failure point?
Yeah.
You mentioned it relates to the business model itself.
Exactly. Capital intensity. It fails the test looking at depreciation relative to gross profit. In 2023, depreciation ate up something like 45% of their gross profit.
45%. And Buffett prefers.
Oh, much, much lower. He loves asset-light businesses where that number is tiny, maybe low single digits. While TSMC makes massive gross profits, that 45% figure shows that nearly half of it has to get plowed right back in just to maintain the equipment and stay ahead technologically. It's like a very profitable treadmill, but it's still a treadmill.
That really crystallizes the dilemma, doesn't it? Fantastic business, incredible returns, but always hungry for more capital and rarely cheap. So let's bring it home with the valuation. What does the current market price up near $300 lately actually imply? Let's look at that discounted cash flow, the DCF analysis from the research.
Okay. The DCF models are super sensitive to the growth rate you plug in for future free cash flow, FCF. The current market price is essentially a bet on a specific future growth path.
Right. So let's walk through the scenarios they laid out. What if we're conservative? Say only 5% FCF growth per year going forward, which seems honestly really low given the AI boom.
If you assume only 5% growth, the calculated intrinsic value per share is only around $85, miles below where it trades today.
Okay, $85 is clearly not what the market thinks. What about a more nominal base case?
Yeah.
Maybe 15% growth, closer to their historical average.
Right. The nominal base case using 15% annual FCF growth gives you an intrinsic value of about $175 per ADR. Now, if you're a cautious investor, especially with the geopolitical stuff, and you want a 25% margin of safety,
Which Buffett certainly would.
then your buy price, based on that $175 value, would be around $137. And you can see why Berkshire buying near $70 back in 2022 looked like such a huge cushion.
Okay, but $137 is still way below the $300 level. So to justify today's price, you have to get really optimistic,
You
right?
just go all the way to the optimistic case. This scenario assumes extremely fast, sustained 25% FCF growth every year for a whole decade. Only that kind of aggressive forecast gets you an intrinsic value around $360 or so. That's even in the ballpark of the current market price.
So bottom line for the listener, what does this DCF exercise tell us?
It tells us that today's market price is basically baking in that very optimistic 25% growth for a decade scenario. Yes, the company's fundamentals are strong, they deserve a premium, absolutely. But at this price, there's almost no margin of safety left. No room to absorb a hiccup in demand, tougher competition, or crucially, any kind of geopolitical shock. The market seems to have priced in perfection.
Okay, let's wrap this up. Final summary for you listening. TSMC's financials are incredibly resilient, its tech moat is wide, management is strong, it's a foundational piece of the global economy. But the current stock price reflects near universal belief in continued, absolute breakneck growth, leaving very little room for error or unexpected trouble.
Exactly. We've seen it's this high return, brilliantly executed company, but that comes packaged with being inherently high cost, needing constant reinvestment, and facing these huge external risks, mainly geopolitics around Taiwan.
Which leaves us with maybe one final provocative thought for you to consider. We know the massive capital spending required is a barrier to entry, that's clear. But here's a question. Can TSMC replicate its incredible execution and cost efficiency from Taiwan in its new, much more expensive overseas fabs like the one in Arizona over the next 10 years? If they can't quite match that Taiwanese magic abroad, those phenomenal margins we talked about today could face some serious long-term pressure. And that would make today's price of perfection look even riskier down the road.